finance, we are concerned about a very specific return, a financial return. And what financial return is about cash flows. It's about the cash flow from the asset in the current period, as well as the discounted value of the cash flows in future time periods. And we will measure the discounted value of cash flows in future periods by the price or the value. Finance, and when we're looking at all these assets, we will not explicitly use accounting returns. And again, I know many of you are in our accounting program, but we will not use those accounting returns in measuring financial returns. Accounting reports and their return measures are useful as a signal of future returns, but we are going to always be using financial returns. Our notation, just to give you to come up explicitly with what we will be measuring. T is going to be our time period. V sub T is the price of the asset or the value of the asset at the particular time period. And when we're looking at capital gain, we'll take one or the other. And our cash return, or our dividend from the stock, and interest payment on the debt. So we're going to measure financial returns in this same way for all assets. Again, when we're looking at asset returns, we have two types, and this would be for historical returns. We'll be looking at the current return or the cash return during the period. It's important to remember it's cash, and it'll be interest on debt instruments, dividends on stock instruments, rent on real estate. Capital gain is then the change in the market value from one period to the next. That gives the market's estimate of the change in asset value. Total return during a period will be current return plus capital gain, and again, that applies to all real estate, stocks, bonds, all assets. In equilibrium, the price of an asset should equal the value, which will equal the present value of future cash flows. Again, if we want to then measure a return to an asset of a particular period, we just take the capital gain, V sub 1 minus V sub O, plus the current return, and we will divide that by the price at the beginning, or V sub O. This gives the percent value of that asset, and note in the denominator, some people will list the average value during the period. I prefer the value at the beginning. It makes calculations and implementation a little bit easier, in my opinion, and that's the way we will do it for this semester. Here's an example of 2 years, and we're going to calculate the return for 2020. During that year, we had rent. In this case, we have a real estate, and it's worth $100. Price at the beginning was $3,000. Price at the end was $3,200. We have $200 of capital gain for 2020. Total return then is $300. We can state that in percentage terms by dividing by the asset value at the beginning. So we have the 10% total return there. You see the calculation measurements there. Remember, and this is a major point, finance is concerned about future cash flows and attendant risk. We really don't care what has happened in the past. The only reason we're looking at the past is if it serves as a reliable guide of the future, and that's always a question when we're looking at historical returns.